All right. Well, one of the so-called moral hazards of what's been going on in the banking industry right now is the difficulty that might pop up just getting a simple mortgage, to say nothing of a home equity loan, that banks might scrutinize that more, or customers might, well, bolt more. Mike Aubrey is with the Berkshire Hathaway Home Services Group. He specializes in this sort of thing. He's a big cheese there. So, Mike, spell it out for me. What are we looking for in an environment like this?
You know, interestingly, I'll tell you this, Neil. I don't know that I think that there's a true linear impact between what's happening with Silicon Valley Bank and what's happening on the mortgage side, meaning that the collapse of this bank is not necessarily going to impact the end user in getting a mortgage. And I mean, I hate to say it, and I hate to sort of stand over the warm body of Silicon Valley Bank, but the impact that we're seeing right now is we're seeing rates have dropped 50 basis points since Friday. So what this is going to do is it's going to make people be able to get a mortgage at a lower rate than they were able to on Friday, which is going to stimulate, you know, my sector. I think we're going to see more people out buying based on this rate change.
So if that were to continue, right, and this didn't spread, because if you want to be technical about it, besides what's happened with Silicon Valley and now Signature in New York, we had Silvergate before all of that. So if this were to spread and raise contagion fears, and I think that's, to your point, and I think you're exactly right, a bit premature, but you know, this gets to be as much emotional and psychological as anything else, and that the industry might look at lending more carefully, and that even those looking for loans might move gingerly. So play that out.
I mean, I buy that. I think that let's look at first Fannie and Freddie. I don't think that we're going to see Fannie and Freddie put out some sort of notice to all the lenders in the world anytime soon saying, hey, listen, we're going to change underwriting guidelines based on what's happening with this. I think the more direct impact would be jumbo money, meaning jumbo money is all banks. And I think that you might see banks begin to sort of tighten things just a little bit. And I don't think that that would be put out in the form of a note to everybody who's selling their paper, but rather I think that the guidelines might change slightly, and automated underwriting systems, might be changed on the back end, and that would leave loan originators to sniff out exactly what those changes were.
Got it. So when you talk about jumbo loans, the bigger loans, so let me get this straight, and I think
Sure.
I'm glad you put it in perspective here, that there is and was a fear of a fallout for the real estate market, for mortgage lending, for lending in general. You just don't see that. And I'm wondering now, given the fact that so few are anticipating the Fed will hike rates at all at its meeting next week, maybe stand pat for a while, that could actually work for mortgage demand.
I agree. I mean, I absolutely think that it will work for mortgage demand. I mean, the reality is the last jobs report with that monster number that they put out got rates back up over 7%. And now you look at what happened on Friday, and guess what? There was a jobs report on Friday, and everyone basically closed their eyes to it based on what was happening in Silicon Valley. And so, the number of jobs that came out didn't have a real impact. And if it were not for Silicon Valley Bank and what's going on right now with the Treasury and the Fed, I think we likely would have seen, based on that jobs report, rates go up. But instead, we're seeing the inverse.
Do you worry that could be a problem, though, that the Fed could lessen or loosen its inflationary resolve, and that it's just delaying a problem that'll come back later?
Well, I mean, listen, I think if I had it all to do over again, and I were Mr. Powell, I would have preferred the pull the Band-Aid off quick thing, way back in the beginning, and they had done a quick rate hike all at once, a big number. But instead, I think that the way that they've slowly done this, and the way that they continue to slowly do this, and he's had to double down on being hawkish at this point on rate hikes, I think that at this point, these hikes may be stifling the economy more than helping it, even though they're in fear of what's happening with inflation.
And this might be the catalyst for them to sort of calm down. That's a weird, but a very interesting angle on this. Mike Aubrey, thank you very, very much. We like to get those views out there because you've heard.